Hey friends, Ernie here from the Trader of Futures, and I'm going to talk about technical analysis today. Is it a bunch of bunk? Or can you actually use it to make some money? So I'm going to provide kind of an argument, both for and against, or at least try to point out some of the issues with it. And let me just say this. Over the years, I've tangled with a lot of traders and quants and investors on the real merits of TA and whether or not it has any kind of efficacy. And we'd go back and forth talking about our experience and studies and anecdotal evidence. But in the end, no one ever really changes their mind. Yet we're all declaring victory that our TA Kung Fu is stronger than yours. You know, the only thing that we ever really accomplished is that kind of opportunity to vent, because the truth is most people lose and some win, but it's their wins they attribute to their technical analysis prowess, and their losses, well, those usually fall into a number of categories that are basically best not mentioned. So with that in mind, I'm not going to demonize technical analysis here. I'm not going to try to disprove the merits or try to illustrate the flaws. I'm under no delusion that I can change believers into non-believers. That's almost akin to like changing somebody from one religion to another, or saying, no, you no longer believe in God, or you must believe. I mean, it is really kind of a religion. Instead, I'm gonna provide some insight that might actually benefit you and those people that are using technical analysis as their primary trading tool. So perhaps we can start off with a basic definition of what technical analysis is. And so from my view, it's basically a set of tools and methods that we use to evaluate securities in an attempt to forecast future movements. And we do this by analyzing the past activity of price and, in some cases, volume, although volume seems to be an afterthought for most people. And the vast majority of these methods are focused on chart price action or price action. And this price action, these inferences are made from usually from indicators, those things at the bottom, and oscillators, and then also things that are on the chart, like moving averages and trends and bands, and then also chart and candlestick patterns. So, before I get any more deep into this, it might surprise you that I don't disagree that these methodologies can work and even be helpful. In fact, if a tool has significant, valid statistical proof within the context of a specific market condition, then I'd say it would be foolish just to ignore it. I mean, that's how I actually truly feel. And I know that I've talked about technical analysis at length and really been, give it the kibosh, and it's mostly in the context that most people don't know what they're doing with it. So the thing is that, the real problem with technical analysis, at least for the discretionary trader, for the quant it's like a completely different problem, but for the trader it's twofold. There are two things, two fundamental things. One is that there's just so many different tools, so many weapons to choose from. It's hard to figure out which one will actually work. And then the second problem is our subjective interpretation of how to actually use those tools. And that, in my view, is the real problem. But let's start off with the weapons themselves, because there's literally hundreds of analytical tools that we can choose from, and some are mathematical constructs that are plotted and as indicators or oscillators, usually showing some overbought or oversold condition. and we usually put them, like I said, at the bottom of the price chart. And then there are others that kind of lay right on top of the price chart. Like moving averages or Bollinger Bands. And then there are others that we use to essentially annotate the chart. So when we draw trend lines and things like that. I mean, there's so many of these things that it could literally take a lifetime just to read about them and understand what they are. Never mind, what it would take to actually master just a small number of them. And these tools have been like at the center of arguments. Which one's the best? Or which configuration is the best? Should I be using a 2-period RSI or a 14-period RSI? Should I take the out of the box settings? And the really weird thing is that some of these tools, I mean, you could take this compendium of tools, and some of them will suggest a market direction in one way, and then another set of tools could suggest the market's going in another direction. And not just across the tools do you find this, but even within the same tool, just by simply changing the configuration or the settings, you could actually get a single tool to give you opposing forecasting predictive power. For example, if you use a moving average crossover and you simply change the look back period, in one set of results or one set of configuration, it could show you a bullish market, and another it could show you a bearish market. And it's that way with virtually every one of these tools. So the fact is that there are so many of these tools because no one tool provides any kind of real reliability, and that's the reason why there is no one tool that kind of dominates all the others. Yet traders are in this constant need or this never-ending search for that holy grail indicator. And I know that that's what I did when I was first getting involved in trading, maybe 30 years ago. First, just learning about the various indicators, the RSI, MACD, etc., stochastic, and then looking for how other people were using them and trying to figure out, well, which one was best. There had to be one that was better than the others. But the fact is, I could choose any of these indicators and configure them to anything to either confirm or refute my position. And the truth is that technical analysis and analysts, they tend to choose an indicator that confirms their own personal predisposition. And they basically ignore the indicators when it doesn't confirm their bias. So when they can't find an indicator that actually provides them with that confirmation bias, then it's a search for the next indicator. And another week of study and understanding and blog posts and videos. And essentially what they're doing is that they're unwittingly curve fitting their ideas, their biases. And curve fitting is bad because it doesn't reflect objectivity, and it will most certainly fail in forecasting the future. And that sounds a little weird. You're just saying, hey, I'm perfectly analyzing all this stuff, then it should then end up the way it's all, saying it should go. But that's not the truth. That's a fundamental flaw that we see in automated trading when we look at past data and try to fit all the configuration to fit all that past data. And then we wonder why the system no longer works for any future data. Again, it's called curve fitting. Now, this isn't to say that technical analysis is just guessing. I mean, traders often use a convoluted logic or approximate what closely resembles their predisposition to a market direction. In other words, if the weapon looks good, then they go with it, right? If the tool looks like it should fit, if it looks like it's working and it's easy to understand, they go with that. Some TAs, they're a bit more sophisticated, or they recognize potential opportunities based on market condition or news, and so they revert to a set of tools they think are appropriate for that condition. So in other words, maybe volatility picks up, or the markets achieve some inflection point, all-time new highs, or the Fed has raised interest rates. Otherwise, they just basically stick with what they have and observe the market. Now, if a technical analyst was more consistent, they'd apply those weapons or those indicators in some kind of regular interval in a systematic way. And they wouldn't qualify everything with some need to have some kind of confirmation. But then, if that were the case, then traders would start seeing the efficacy of their ways, But unfortunately, as humans, we're always trying to take squiggly lines and make them straight. We always think that we always know the right tool for the job, as Dad would say. Get the right tool for the job. But the fact is that all we're really doing is that we're magnifying our confirmation bias. So, that's generally the problem that I have with tools. There's so many of them, and we try to use the tools that we think will meet the need. Never can really just fixate on one thing. So the second thing that is kind of related and what I wanted to talk about, one of the biggest problems is this sort of subjective interpretation of those tools. Some people will look at a color and some people see blue and others see green. And so when you look at a chart, what is it that you actually see in the chart? If you were to take different traders, it's not hard to find two different analysts, for instance, arguing over a formation like a head and shoulder, and whether or not it's actually appearing, or whether or not that's a cup and handle formation. Unfortunately, most traders have a different interpretation of what makes a proper pattern, and there's no real standards that they can actually comply with, or look at, or even understand what is the statistical probability under what context that pattern actually exists. It comes down to kind of like a psychologist test, doing the ink blot test. What is it that you see? A butterfly or a vagina? Not suggesting that you would see vaginas in stock charts. So, if technical analysis is a discipline meant to eliminate the impact of our biases and our emotion, I'd be all for it. But the problem is that once a trader is out there on their own, there's nothing stopping them from falling prey to those things that direct them one way or another. They're going to see what they want to see. And this is particularly a problem with methodologies like Elliott wave. If you get 50 Elliotticians all looking at the same chart, I guarantee that you're going to get probably 25 different analytical results. You could probably say the same thing about Fibonacci retracements. Look, I'm not saying TA can't play a role in successful trading. In fact, it can. The fact is that patterns do exist in stocks and futures and even in the crypto market. And understanding those formations and the context, that's the important part. The context, that is the key to determining whether or not they actually have some kind of advantage or some statistical significance. The context within which that market and that pattern exists. The problem is that most people are basically taking what I call a swag, or a scientific wild ass guess. I believe that is a kind of military acronym, but it really follows. So I guess the problem can be explained this way. If an analyst writes a blog or posts a YouTube video analyzing a particular stock, and the analyst presents their argument and his or her views, then you get all the commenters, and I get plenty of commenters. They'll react with this whole range of things, from praise to even declarations of heresy, like, you just committed the worst sin you could possibly ever commit, and now I'm going to dedicate my life to troll you for the rest of your YouTube existence. And the fact is that everyone has the same data. They just simply value it differently. And each trader bases those conclusions on their experience and their interpretations, which could be the same or completely different than the analysts. People weigh their personal experiences and convictions greater than objective information. So people can't separate themselves from their beliefs. I mean, that's kind of like what it comes down to, you know? You can't separate yourself from, you can't devoid yourself of the emotions, for instance, or your personality. I mean, we all have these sort of well-defined personalities that we carry as kind of baggage. It's our psychological makeup. I mean, just look at politics. I mean, you get wackos on both the left and the right, that political spectrum, and it's almost as if some people, even in the middle, can be bipolar, but they have such opposing views. You wonder how you can look at a particular event and see it in two completely different ways. And it's the exact same thing with analysis of markets or any kind of data for that point. You know, it doesn't have to be trading. So, but regardless of this kind of innate bias that we have, there are some traders that absolutely demonstrate positive, consistent results. It's an absolute fact that there are some people that are just successful. The difference is that you can't say that you can then take a prescriptive formula that they're using and then give it to somebody else and have them achieve the same success. And the fact is that you could actually take one of these very successful traders and then sit down and say a newbie trader right next to them. And the successful trader will be doing their thing. The newbie trader will try to duplicate what they're doing and end up not being as successful as that successful trader. So a successful trader using TA isn't successful because of the predictive power of the TA. They're successful because they've developed sufficient experience and often have a heightened intuitive sense. And that allows them to see patterns and signals and that other people they simply can't see. They're successful despite the chart, not because of it. And I think that's the real trap that most people fall into. They develop this dependency on the charts, thinking that that is what's going to provide their success, and getting better at analyzing that. And what it really comes down to is the individual intuit and experience of the trader. And also that some traders are simply lucky. And I know that this one's kind of hard to swallow, but the fact is, and statistics support this, that some people are just downright lucky, and we hate those people. I mean, I was just talking to one of my very early mentors just the other day, and he told me as such. He said that early in his career, he just happened to be in the right place at the right time, and as a broker, there were enough suckers willing to throw money his way to make some amazing deals. And then after accumulating some real money, he got lucky with a few trades that catapulted him into the area of fuck you money. From there, he was kind of anointed as this sort of master trader, and he developed that reputation when he actually knew the real truth. And this is what he actually admitted to me just yesterday. Now, after that, it was a struggle for him to kind of hold on to his wealth. So what he did is he adopted this very, very defensive posture, very similar to what a lot of us do after we have, say, an extended loss. All of a sudden, we grind it out and try to grind it out until we get back up to the top. Well, he essentially did the same thing. And he adopted this posture of just preserving his capital at all costs, and developed that kind of philosophy. Now, his wealth, this newfound wealth, exposed him to a whole bunch of people and money, and so he got to explore a lot of different methods and quantitative ideas, and starting hedge funds and that sort of thing, to exploit technical analysis, to take all these ideas that he knew about that, maybe if we had the right tools and the right people, we could actually make something of it. So, side note, there are many ways to profit when you have the power of data scientists, astrophysicists, and sophisticated algorithms working for you. But this is a far cry from being a discretionary trader using technical analysis. However, there are absolutely lessons to be learned from this kind of quantitative trading that can be applied to discretionary trading with technical analysis. For example, short-term trading is extremely risky, and it's really difficult to profit from. We see this in the actual backtesting and real-life results of trying to create strategies that trade short-term versus medium-term versus long-term. the fact is that the longer you hold a position, the longer your time frame and your strategy, the easier it is to profit. And this is directly reflected if you just look at the most successful traders in the world. The most successful traders are all trend traders. There are no short-term traders that can be considered the most successful traders in the world. They don't exist. The other thing that you can learn from this quantitative trading and systematic trading is that the context of the market is extremely important and really the determining factor whether or not your specific strategy is going to work. So that simply works in the same manner for people using technical analysis. As an example, if you have a very bearish outlook on the market, and that's your bearish bias because it's obvious, the market is in a bear market, then why would you take longs in that market? You would only use your technical analysis to reflect, that overall context of the market. The other thing is that this sort of contextual thing that I'm talking about, you finding a sound hypothesis that provides a definitive edge, and then trading technical analysis or any kind of method around that within the context of that edge is really the key to successful trading. And there is one other thing that even goes beyond that. Developing kind of a very systematic approach to your trading, a way to kind of time box everything and evaluate things on a periodic basis. Create like an OODA loop or a continuing improvement process. Extremely important. And, what I'm basically saying is that technical analysis is not the panacea, and far from it. It should really be viewed as a tool that you use to kind of model your ideas. And that it takes experience and, hard knocks and that intuit to really become consistently successful. I guess the other thing that I put in that context, the other big thing that I think that will elevate your success, and this is shown quite clearly from the hedge fund model, for instance, and that is that within this kind of systematic approach, you want to trade a number of strategies, a number of what we call non-correlated strategies, that they're strategies where the results or the returns are very different from one another, that they are based on individual hypothesis and strategies, edges, their entries and their management are managed in completely different ways from one another. Trading multiple non-correlated strategies within this context is about as close to the holy grail of trading that you'll ever find. And so that doesn't mean that you have to get complex with the strategies or your technical analysis. It just means that these things have to be different. So find a hypothesis, find an edge within that hypothesis, use technical analysis to kind of model that edge, trade multiple strategies, trade small, keep your position sizing and exposure to a minimum, and trade within a systematic process. There, I think, that's when TA will start to shine. It will look like, the TA is the big hero, but it won't be. It'll be that entire package. So if you have any comments on this, I'd love to see them. Put them down below, and we'll see you next video.